The market is currently closed. As of the final closing bell on Friday, June 5, 2026 at 4 p.m. Eastern Time, SoFi Technologies traded at an exact price of $16.03 per share. This represents a sharp intraday drop of 6.53%, stripping away $1.12 from its previous price of $17.15 on high trading volume of nearly 82 million shares. While most market participants are fixated on this abrupt downward swing, attributing it to broader retail exhaustion or typical short-term volatility, a much deeper structural divergence is occurring under the hood. On the exact same day this price contraction took place, fresh institutional tracking data revealed that SoFi achieved a striking 72% score on the Rule of 40 metric. This is an elite benchmark that combines revenue growth and profit margins, usually reserved for elite software firms rather than consumer finance platforms. This creates a fascinating disconnect. The immediate market narrative views this stock as a volatile, interest rate-sensitive consumer lender prone to sudden sell-offs. But the reality is that the underlying business is scaling with the efficiency of a high-margin enterprise. This brings us to the core tension that makes this asset one of the most polarizing names in modern retail finance. The common consensus on message boards and among everyday retail investors is that this asset is an excellent vehicle for self-investing, a hyper-growth consumer app destined to run up alongside big names like Tesla stock or Apple stock whenever the retail trading crowd catches fire. Many look at it simply as a shinier version of a standard retail app, assuming its valuation moves solely based on user acquisition numbers and student loan headlines. The contrarian reality, however, is that the company has quietly spent the past year shifting its fundamental economic engine away from volatile lending originations and towards subscription-like financial services and enterprise-grade software infrastructure. The market is pricing it like a cyclical bank, but its internal metrics are behaving like a scalable software network. When expectations are built on simple retail hype, a sudden 6% daily drop causes panic. But when you weigh those expectations against the reality of a 42% year-over-year revenue climb to $1.1 billion for the opening quarter of 2026, the picture changes completely. To truly understand the daily swings we are witnessing, we have to look closely at the institutional chessboard and recent macroeconomic pressures. Throughout the past few trading sessions, the asset has encountered fierce resistance near the $18 mark, a level it briefly breached in late May following a massive short-covering squeeze that saw volume explode past 150 million shares in a single day. That massive rally was catalyzed by the native deployment of their new US dollar stablecoin, built right into the app across major blockchain networks, marking the first time a federally regulated national bank has launched such an asset. Yet the subsequent pullback to the $16 range shows just how quickly short sellers re-established positions. Institutional activity reveals a stark divide. While hedge funds like 2 Sigma pulled back their exposure, mega institutions like UBS Group and JP Morgan Chase aggressively increased their stakes, adding millions of shares to their portfolios. This massive institutional accumulation suggests that while retail traders are shaking out during these steep daily drops, sophisticated funds are quietly building long-term blocks. They recognize that a forward price-to-earnings multiple near 25, while rich compared to traditional regional banks, sits well below the historical average for this specific asset when its growth engine is firing on all cylinders. The broader macroeconomic backdrop has kept a heavy lid on the entire sector, adding severe friction to recent price action. Stubborn inflation indicators and a consensus that formal rate cuts are completely off the table for the remainder of 2026 have forced investors to recalculate their assumptions. For a modern digital lender, the difference between an aggressive interest rate hiking cycle and a stable, flat-rate environment is massive. It dictates net interest margins and the long-term health of personal loan portfolios. When investors browse popular investing sites or seek professional investment help, they often see this asset grouped with high-beta fintech plays that collapse the moment consumer credit tightens. The daily trading volumes tell a story of constant accumulation and distribution, where short-term traders treat the stock like an option play on macroeconomic data, while the underlying equity absorbs the selling pressure. Comment below how many shares of SoFi stock you currently hold, and let me know if you are actively buying this recent dip or waiting for a deeper pullback. This continuous tug-of-war between high short interest and institutional accumulation creates an incredibly volatile environment, where any sudden macro shift can trigger an outsized price movement. When you look across the digital wealth ecosystem, the competition for consumer capital has intensified dramatically. Users are shifting funds across various platforms, weighing the benefits of automated systems like Schwab Intelligent Portfolios against the active features found on a traditional online brokerage. For an individual brokerage account holder, the choice often comes down to where they can get the highest yield on uninvested cash and the most seamless user experience. Platforms like Robinhood have pushed hard into crypto and cash management, while legacy giants like Fidelity Investments continue to dominate long-term wealth holdings through institutional Fidelity ETFs, traditional mutual funds, and their massive wealth management divisions.
In this environment, an app cannot survive merely by offering a clean mobile app or a basic trading platform. It has to offer an interconnected ecosystem where a user who enters the platform for a single product can be cross-sold into an array of higher margin services. This is precisely where the expectation of a simple digital app collides with the reality of an integrated financial platform that holds a full national bank charter. This structural foundation is what separates the firm from earlier waves of digital consumer finance companies. The business model has evolved completely from its roots as a niche student loan refinancing shop into a fully diversified financial infrastructure enterprise. By securing a national bank charter years ago, the company freed itself from the costly reliance on third-party partner banks to fund its loan originations. Instead, it uses its rapidly growing consumer deposit base to fund its loans directly, significantly lowering its cost of capital and boosting its net interest margins. The company operates through three distinct segments: lending, financial services, and the technology platform. The lending side manages personal, student, and mortgage loans, using rigorous data analytics to underwrite credit risk. The financial services segment houses the consumer-facing products, including checking accounts, high-yield savings, and an active online investing suite. Meanwhile, the technology platform, driven by major acquisitions like Galileo and Technisys, acts as the invisible digital backend for other financial institutions worldwide, processing billions of transactions and generating steady, fee-based enterprise revenue. This three-pronged approach creates a massive natural hedge against changing market conditions. When high interest rates suppress loan originations on the borrowing side, the high-yield deposit accounts attract massive inflows of retail cash, which can then be deployed into high-yield assets. Conversely, when the macroeconomic landscape shifts, the technology platform provides a consistent stream of recurring revenue that behaves much more like a software-as-a-service business than a cyclical lender. Older financial reports from previous years show a company that was heavily reliant on the premium it received by selling its loans to third-party investors on the secondary market. When that secondary market dried up during the sudden liquidity shocks of 2022, the stock suffered a devastating peak-to-trough collapse of over 83%, far outpacing the broad market declines. That historical trauma is exactly why the bear case remains so entrenched today, with many analysts warning that the business is highly vulnerable to consumer credit cycles and sudden defaults. The legacy narrative dictates that a rapid increase in unemployment or a prolonged economic slowdown would break the asset's credit models, leading to severe loan loss provisions that would instantly wipe out its hard-earned net income. However, looking at the actual performance figures from the recent quarterly updates, the reality is actively challenging that bearish thesis. Total revenue for the business has moved aggressively to a trailing 12-month figure of $3.9 billion, representing a phenomenal 40.9% expansion rate at a time when the median growth rate for standard large-cap corporations sits in the single digits. Net income margins have stabilized around 14.6%, proving that the business is no longer burning capital to buy growth through expensive marketing campaigns. Instead, the company is realizing profound operating leverage, where the cost to serve an existing member drops precipitously as that member adopts multiple products across the ecosystem. This cross-selling efficiency is the ultimate metrics driver that traditional banking analysts struggle to model accurately. When a consumer uses the app to manage their direct deposit, buy fractional shares, and track their financial health, the platform captures an incredibly valuable, holistic view of that consumer's cash flow, enabling highly precise underwriting that mitigates traditional credit risk. As we look toward the future horizon, the long-term outlook for the asset will be defined by how successfully it navigates several critical catalysts and structural risks. The primary upside opportunity lies in the rapid scaling of its technology infrastructure segment and its fresh digital token initiatives. If the company can successfully transition more global regional banks onto its core operating platform, its revenue profile will shift dramatically towards ultra-high margin software fees. This would cause a massive structural re-rating of the stock, compelling the market to abandon its bank-like valuation models entirely and apply the premium multiples enjoyed by elite tech networks. On the flip side, the risks are heavily concentrated in the consumer credit arena. If macroeconomic pressures push personal loan delinquency rates beyond the company's internal projections, the resulting capital preservation measures would severely slow down its growth engine. Furthermore, competition remains relentless, as every digital platform from agile fintech startups to trillion-dollar legacy institutions is fighting aggressively to capture the exact same affluent consumer demographic. The central insight for investors to weigh is that the massive disconnect between short-term share price volatility and long-term operational execution shows no signs of slowing down. The short-term stock performance remains highly erratic, heavily influenced by options trading, short seller activity, and shifting narratives surrounding federal interest rate policies. This creates an environment where a sharp single-day drop can easily obscure the reality of consistent, high-velocity revenue growth and expanding operating margins. For anyone managing an individual brokerage account, checking a digital trading platform daily can create the false impression of a business in distress, when the corporate reality is a firm that has managed to sustain an exceptional growth profile across a highly complex and restrictive macroeconomic landscape. The market continues to treat the equity as a speculative retail trade, while the financial statements increasingly look like those of an established, mature financial technology leader. Ultimately, the long-term trajectory of this asset will break the tension between these two opposing views. Either the bears will be proven right as consumer defaults drag down profitability, or the structural reality of their scalable, highly efficient digital ecosystem will force a massive, permanent upward re-rating that aligns the stock with its true software-like characteristics. For investors navigating the modern digital landscape, separating the noise of daily market action from the concrete execution of the business model is the only way to build true conviction. The contrast between expectation and reality remains wider than ever here, and how that gap closes over the coming quarters will provide the definitive answer to one of the market's most fascinating structural debates.